welcome to Ainsley News. Welcome to the week. It's Monday the 14th of June. We're going to talk about how the Fed has hit $8 trillion in UST yield's biggest yearly drop. But also, we're announcing today that Ainsley Bullion is extending its reach down into Victoria, Melbourne, and Ainsley is now opening up shop down there. So if you do have friends, family, and other associates who would love to jump into the Ainsley Bullion experience, that's both bullion and crypto, we'll be opening up around the end of the month here or early July. But we'll keep you informed, but it's very exciting news from us. So back to the news. Despite raging inflation prints last week, bond yields plummeted on Friday night, making the cumulative drop in 10-year Treasury yields last week the biggest in a year. The market is screaming it thinks this inflation is indeed transitory, or at the very least, that the Fed will not even ease or taper it. Here's this chart here of UST 10-year yield. It could also be the gravity of the trap the Fed is in hit home on the news that last week we saw the Fed's balance sheet hit $8 trillion. Remember the amazement when it hit 4.5 trillion after QE3. And critically, remember how it crashed the market at the end of 2018 when it tapered it back to just 4 trillion. Well, it's now double that, and both government and private debt massively higher too. The market is basically saying that regardless of whether this inflation is transitory or not, the Fed is trapped in an easy money death spiral. Here's that chart here showing the Fed balance sheet versus the S&P 500. And so, as we talked about on Friday, negative rates are firmly here to stay. And that is great news for gold. The following article we're going to talk about here from Mike Shedlock is a great analysis of this correlation. This is it here. Real interest rates suggest it's a good time to buy and hold gold. Let's investigate the relationship between real interest rates and the price of gold. Here's this chart here, just showing that correlation. Real means inflation adjusted. I calculated the real interest rate by subtracting year-over-year CPI from the current 3-month T-bill yield. One could also use the Fed funds rate or 1-month T-bill rate, as the yields are all about the same. Here's the CPI year-over-year versus 3-month yield chart here from Mishtalk. The following chart puts the negative interest rate theory to the test. Real interest rate versus the price of gold. Check that out here. The chart we just shown you shows the monthly gold close, not the monthly highs. That explains why the 1980 top doesn't show. And here's a synopsis. Gold took off on the stagflation years, then collapsed from $850 to $250 an ounce with inflation every step of the way. Note that between 1980 and 2000, the Fed kept real interest rates in positive territory, except for one minor and brief moment. In response to the dot-com bust, housing bust, and COVID-19 recessions, rates have been generally negative. The first question mark around 2006, gold kept rising despite positive rates, but that's if one believes the CPI. If one factors in housing, real rates, we were indeed quite negative. One might also argue the charts reflects anticipation of the financial stress of a housing collapse. The second question mark pertains to ECB President Mario Draghi's statement. We will do whatever it takes to save the euro, and believe me, it will be enough. Simultaneously in the US, there was an endless speculation about Fed normalization, ending QE, tapering, hiking rates, etc. People actually believed the Fed would do all these things, and that made for a rough spell as gold fell from over $1,900 an ounce to around $1,100 an ounce. Timing versus magnitude. Real interest rates suggest nothing about magnitude of the move. Rather, it's a directional indicator. It goes along with that I have previously stated about faith in central banks. Here's a chart here showing gold versus faith in central banks. Is everything under control? When the Fed has positive real rates, gold tends to do poorly. Real interest rates approached 7% in the early 1980s. If that happened now, the 3-month T-bill would yield an astonishing 12%. And now how likely is that? And that's news for today. Thanks for joining in. Remember ainsleybullion.com.au for all things physical, ainsleywealth.com.au for all things cryptocurrency, and goldsilverstandard.com for our own crypto built and backed by real gold and silver. Enjoy your Monday, everyone, and we'll catch you tomorrow for more news.